Are you curious about how equity release can affect your benefits? Well, you're not alone. This is one of the most searched questions on the internet when it comes to equity release. In this video, we'll delve into the details and provide you with all the information you need. So, let's get started. First, let's understand what equity release actually means. It's a method used by senior homeowners to access some of the money tied up in their property, without having to make regular repayments. You can receive a lump sum or a drawdown facility, and the amount borrowed is typically paid back when the property is eventually sold. The best part is, you can continue living in your home for as long as you want. Now let's dive deeper into the two main types of equity release: lifetime mortgages and home reversion schemes. A lifetime mortgage is one of the most common methods in the UK. With this option, you release a percentage of your property's equity and pay a fixed interest rate on the amount taken out. The interest rolls up over time, which means it continues to grow and adds to the total debt. However, you can choose to make voluntary interest repayments if you want, to reduce the overall debt. There's also a variation called enhanced lifetime mortgages. These work in a similar way, but take into account your medical history. If your life expectancy is lower, you may be able to release a larger lump sum. On the other hand, home reversion plans are less common. They involve a company offering you a loan in exchange for a percentage of your property's future sale proceeds. While they don't charge interest, the amount they claim in the future is usually more than double the amount that they provide up front. Now let's address the big question: how does equity release affect your benefits? The answer depends on whether your benefits are means tested or not. Means tested benefits consider your income and savings to determine eligibility. If you increase your savings through equity release, you may no longer be eligible for some benefits. These include pension credit, universal credit, and council tax reduction. But here's the interesting part. By spending, gifting, or donating the released funds in legitimate ways, you can reduce your savings and potentially continue to receive your benefit payments. So, it's essential to understand the specifics and finer details, including the savings thresholds for different benefits in the UK. Now that we've covered the impact on benefits, let's explore the advantages of equity release. First, the money you receive is tax-free, whether it's a lump sum or a drawdown facility. This means you don't have to worry about paying income tax or capital gains tax on the payment. Secondly, you can use the money for anything you wish, whether it's home improvements, travel, or simply enjoying your retirement. And when you have a lifetime mortgage from a lender who's a member of the Equity Release Council, they provide a guarantee that you'll never owe more than the market value of your home. Of course, there are some disadvantages to consider as well. The primary drawback of lifetime mortgages and home reversion schemes is their cost. While the interest rates on lifetime mortgages may be low, the amount owed can more than double over a decade or longer. Home reversion plans, on the other hand, usually undervalue the property, meaning you'll pass on less through inheritance than you would have otherwise. This can be especially challenging if your beneficiaries are not financially secure themselves. Now let's focus on how equity release impacts state benefits. If you receive means-tested benefits such as pension credit or universal credit, taking out equity release can affect your eligibility. Means-tested benefits consider your income and savings, and increasing your savings through equity release may result in reduced or lost benefits. However, benefits that are not means-tested should not be affected. For instance, let's talk about pension credit. It's a top-up payment to the state pension for individuals with low income. The amount you receive depends on your savings. Currently, anyone with £10,000 or less in savings receives the full top-up amount. But if your savings exceed £10,000, your pension credit payments will be reduced. For every £5,000 in savings above £10,000, the payment is reduced by £1. So if you take out equity release and have savings above £10,000, your pension credit payments will likely be affected. Another benefit that may be impacted is council tax reduction. If you pay reduced council tax based on your income and neither you or your partner receives pension credit, having savings above £16,000 can make you ineligible for the reduction. However, if either you or your partner still receives pension credit, your council tax reduction will not be affected. Remember, each local authority can have its own savings threshold, so it's worth checking the specific rules for where you live. Finally, let's talk about universal credit. It replaces several other benefits and is affected by your savings. Individuals with savings exceeding £16,000 are not entitled to universal credit payments. Therefore, taking out equity release to increase your savings beyond this threshold can impact your eligibility for universal credit. Before we continue, it's important to address a crucial topic: fraud. Deprivation of assets fraud involves hiding assets to continue receiving means-tested benefits. While it's legitimate to spend or gift the released equity, it's essential to do so genuinely. If you're intentionally manipulating your savings to maintain benefits, it's considered fraud. So always make sure your actions are lawful and consult a financial advisor for guidance. Now, you may be wondering if you can release equity with poor credit. The answer is yes. Unlike other loans, equity release providers don't usually assess your personal finances or credit score. They focus solely on the value of your property and its marketability. So even if you have poor credit, you can still explore equity release options. Before making any decisions, it's crucial to understand the potential pitfalls of equity release. One of the most common pitfalls is not fully comprehending the details of the agreement. That's why it's highly recommended to seek advice from an equity release advisor who can guide you through your options and explain all the nuances of the deal. Ensure that the company or professional you choose is authorized and regulated by the Financial Conduct Authority for independent financial advice. Equity release can be an effective way for senior homeowners to access funds tied up in their property, but it's important to consider its potential impact on means-tested benefits. By increasing your savings through equity release, you may no longer be eligible for certain benefits or see a reduction in the amount that you receive. Understanding the specific rules and seeking professional advice can help you make the best decision for your financial situation. If you're interested in seeing if you could release equity, then simply click the link in the description below and fill out the short form. It contains a few questions like your property value and your date of birth, and it will give you access to quotes tailored to your circumstance. It's totally free to fill out, and of course it won't affect your credit score. Click the link in the description below and fill out the short form to try it out.